This is a great question. So Vicky asks, what is the difference between a mutual fund and the index fund? Now, an index fund is a type of mutual fund. However, with a mutual fund, you're basically pooling your money together just like you would with an index fund, but you're pooling your money together in a mutual fund with other people, with other investors, institutions who are pulling your money into this mutual fund. And essentially, the mutual fund can be either a passive mutual fund or an active mutual fund, an actively managed fund or a passively managed fund. And so index funds are a type of mutual fund, and the index fund is going to be one of those that's passively managed mutual fund. That's what an index fund is, because basically an index fund is going to track an index, one of all these indices out there, like the S&P 500, like the Dow Jones, like the Nasdaq. So you've got all these different indices out there, all these, and the index fund, what that does, it's going to track one index. So perfect example is the S&P 500, Standard & Poor. It's a company. Standard & Poor is a company, and they have what's called the Standard & Poor 500 that basically puts together, they've done the research. That company is putting together the top 500 companies in the US. So they say, here is the S&P 500 index. There you go. And now all these other companies, Vanguard, Charles Schwab, TD Ameritrade, Fidelity, they're going to say, they're going to get that information and they're going to create an index that's going to automatically follow that group of companies that Standard & Poor has listed. So there's no work really being done for an index fund by Vanguard, Fidelity, or whoever it is. They're basically just copying what Standard & Poor is doing. So index funds are copying the indices that are out there. So whether it's a Standard & Poor 500 index, or if it's another type of index like a world market index, there's an index fund that's going to copy that, and it's going to give you the opportunity to invest in all those companies, usually at a low cost, very cost efficient. Now, when you get to an actively managed mutual fund, remember, mutual fund is the broad category. Index fund is just a kind of mutual fund. Now you have other kind of mutual funds that are actively managed. So you have people who work for Fidelity, who work for these financial institutions, who are going to manage that mutual fund. So they're going to try to buy more of this stock or sell more of that stock, or buy more of this company, sell more of that company, so they can try to do better than that index. The index is just kind of automatic, but a mutual fund is always trying to beat the index that it's competing against. So you can have what's called a blue chip mutual fund, or what they call a large cap mutual fund, and typically that's going to compare to an S&P 500 index. And so the large cap mutual fund, somebody's managing that fund, and they're trying to buy more of whatever company, sell more of this company, and they're trying to basically manage that fund to outperform the index. The problem is, you have so many of these money managers, these mutual fund managers, like I think the number was like 80%, who cannot outperform the index fund. So if you just buy the index fund, you're actually going to be doing, based on history, you're going to outperform 80% of those fund managers who are trying to beat that index. So mutual fund, broad category, index fund is a type of mutual fund. The good kind of mutual fund is what I would say. But then you also have other kinds of mutual funds that are going to be higher cost, that you do have that potential to outperform the index. But based on history, you've got a 70-80% chance that you're not going to outperform the index. So that's why a lot of people in the FI community, the financial independence community, just say, get the index, because you're going to outperform. You typically, in the long run, right? Year to year, you know that mutual fund may outperform the index, but on the long term, 30, 40 years, you're going to do what, if history repeats itself, you're going to outperform the fund managers.